To be self-insured, a state agency needs to have a line item in their budget that states you have money set aside to pay for any damages to your building or your assets, contents. So if your agency has that, you are self-insured. The other option is if you're from UT, TxDOT, A&M, or Texas Tech. You have your own insurance programs. Some of them are self-insured. Otherwise, I would beg to differ that you are not self-insured. You're uninsured. So that's just a simple activity for you to consider when you go through this property request that's going to be coming down through the COOP plan for the next couple of weeks. Or months, I should say. I'm going to run through with you a little bit of a timeline to give you background on the property program so far. The insurance unit at SORM was created in 2002. Our job at that time was predominantly to review insurance purchases that state agencies were making. All insurance purchases, except workers' compensation, of which at this point you're aware, state agencies are self-insured through SORM's workers' comp program. Insurance company, state agencies were purchasing insurance at that time. Some of them were being sold limits that were way higher than our Texas Tort Claims Act limits. Some were being charged premiums which were way too high for what they were purchasing. So SORM was pulled together and asked to create an insurance unit in order to review these insurance purchases and to assist state agencies in making better choices, making sure the coverage that they were requesting was what they needed, and to help them find the best deal. In doing so, we discovered that many state agencies were purchasing the same types of insurance: property, automobile, directors and officers, and volunteer insurance. Through our board's approval, we created some SORM-sponsored programs, those 4 lines: property, directors and officers, remote, and volunteer. By pooling all those agencies together and buying the same coverage for all of the agencies, we're able to utilize the buying power of those purchases. As my job now, I negotiate for state agencies to find them the best coverage for the best price. I beat these people down to try and find the best stuff for the state agencies. So we've had this property program in effect since 2006. And the first 5 years for our request for proposal, 1-year renewals, we had one insurance carrier who handled the state's assets for those that participated in the program. It is not a compulsory program. It is elective, but agencies who had to have that insurance, if they'd gone to FEMA, as Trey had explained previously, they would purchase that insurance, and more education has taken place. Agencies are realising that they do have the potential loss exposures out there, and they are purchasing property insurance in our program. We now have 26 agencies that are currently in that program. We went out for RFP in 2010, and we thought about restructuring the program. Gallagher put in for the program. They gave us a bunch of different options, and we purchased insurance. Looks like a big patchwork quilt of approximately, at that time it was about 26 insurance companies. So moving from all eggs in one basket to sharing that risk between 26 insurance companies made us feel an awful lot more comfortable.
It's very similar to what you heard him talk about, how most programs, especially large programs nowadays, have multiple insurers involved, and it really, especially in terms of stability, it helps diversify your risk so that if any one year an insurance company, say, goes insolvent or just changes their tune, we have other carriers that can replace them.
Absolutely. So, we talked a lot about in that last session about subrogation, people having insurance, not having insurance. Well, in 2008, we saw those two parties come together. We saw Hurricane Ike come across the coast of Houston, Gustav coming down towards Brownsville, the governor's mansion burnt down. That was in 2008. As you're aware, our legislative session sits every 2 years. And in the 2009 session, we had many state agencies fronting up to the legislature with their hand out saying, we're self-insured, I need some money to build my building back. It wasn't taken too lightly. My executive director, Jonathan Bowe, was actually called over. And Jonathan, would you like to share what happened when you received that phone call?
You know, I guess to say the first thing that you need to know is the loss at the University of Texas, Galveston School of Medicine, conveniently located on a Texas beach. And they suffered a loss of about $800 million in total. That year, the legislature had a couple of votes in front of them. There had been a big blow-up about the governor's mansion. If you don't recall, the governor's mansion was undergoing some renovations and some remodeling. And while it was unoccupied, and someone threw a Molotov cocktail onto the front porch, which gutted the building really down to the stone. So they had those two big losses. There had been a lot of publicity. People in Galveston wanted their medical school back. The newspapers kept printing articles about what sort of idiot doesn't insure his house. Well, that would be the governor of the state of Texas. And we spent a lot of our time trying to get people to understand what that really meant. The person who doesn't insure their house is somebody like Bill Gates who just buys another one if he doesn't like what he's in. Yeah, that's much easier than getting it cleaned and repainted. So it was a time of confusion, and they had a Senate committee which is in charge of looking at the appropriations requests for dealing with these losses. I was sitting in my office one afternoon, and I got a phone call asking if I could be in front of the Senate in 15 minutes. Like, well, yeah, I guess I can. So I went over, and the legislature asked me some really tough questions about kind of where the state was. I had to explain the 1926 Senate Joint Resolution that said that the state would, so far as possible, self-insure for losses until such time as the state created a statewide program for insurance. That had really never happened before. They wanted to know whether or not state agencies had to buy insurance. And we explained to them that no, state agencies determined their risk and their ability to retain that risk and made their own choices. And they asked me, well, so should we just pass a law that requires all state agencies to insure all of their property? I was like, please don't do that. Do not send 120 some odd state agencies into the market at the same time trying to negotiate for capacity. They will literally be driving each other's costs up in that marketplace. Two, they've never been funded to purchase insurance on that scale. The estimates at that time were somewhere in the neighborhood of $40 to $60 billion worth of state properties that they were talking about insuring. Fortunately, we were able to reach them to the extent that they did not pass a law requiring all agencies to go out and start looking for insurance. What they did instead was they charged us with going away and coming back with the blueprint for a structure that would support the state and provide it with its insurance needs for property. It's still not exactly what it needs to be, still doesn't have a retention. We produced a report, a set of recommendations for how that program should be structured to give state agencies the maximum benefit, and that is with the legislature. But yeah, all I can really tell you is you don't really want to be the guy standing in front of the legislature with your hand out saying, it fell down, please can I have another one? They don't like that question, and they want to know why you're talking to them. That was the question.
So that leads very nicely, segueing into the state insurable asset study. One of the recommendations that we made back to the legislature was it's difficult to advise you on how best to handle the state's assets when we don't know what the entire state owns, where it's geographically located, and how much it's worth. So we have, through the use of this COOP plan that's coming up, we will be requesting from state agencies a list of their assets, and Maureen Clements is going to talk further on that during her presentation after lunch in regards to collecting that data so that we can assist you in doing your business continuity and COOP planning and assist the legislature in providing them better information on how better to handle the state's assets. So with that said, I'm going to hand it over to Chris to talk more about the property program and what it is.
promise this will be brief. I know we have lunch right back up to lunch, so we'll go through this relatively quickly. But overall, kind of the analysis that Michelle had done, and just raising your hands whether you're insured or not insured. But we'd start off with just kind of the helicopter view on what is property insurance. Why do people buy property insurance? There's obviously a lot of different elements to property insurance. We all have, homes and buy homeowners insurance, so that's a form of property. But really what it's designed for is to protect against infrequent catastrophic types of losses. So examples such as a hurricane, tornado, could be a large fire. It's something that would have a catastrophic effect to your agency's budget. We always recommend to really assume a small risk. So if you could, let's say your agency lost a laptop. In most cases, that's something you can replace within the budget that you already have. So that doesn't make a lot of sense to insure that type of exposure. But let's say you had a theft where you had 100 laptops stolen. Well, that might be something you consider insuring. So I put together kind of a risk matrix that a lot of us insurance folks look at in terms of what is best suited for insurance for risk transfer. If you look at this chart here, you can see there are 4 quads on this quadrant. So this left side's probability. So what that means is how often is it going to happen? Is it a 1 in 100-year event? Would it happen 10 times in a year? Would it happen 100 times in a year? So that's the probability on the left side. If you look at the right side, it says consequence. Should have probably drawn a dollar sign there. That's basically how expensive is it. So as you move to the right, that's more dollar cost, higher in cost than on the left side. You see that arrow that goes, it says avoid that category. What avoid means is, let's say you knew that you had a location that was situated directly on the banks of the river. And you knew that every single year during the spring, that river flooded and caused damage to your facility. That may be something where, because it has such a high cost, it's to the right of that category there in terms of dollar cost, and it happens frequently, it's all the way to the top of the probability side. That may be something where you say, well, let's either move that facility inland, or let's elevate the foundation of the facility so it doesn't flood. So those types of events really are best to avoid. On the left side of the consequences, the low dollar amounts like the small laptop theft, or it could be a small fire or small smoke damage, those elements are really the best to retain. So within the funding that you currently have, if you can afford to retain those risks, we advise to do so. You can save money on your insurance costs by doing that. Then the rest of my presentation is really focusing on that right quadrant on transfer. So that is what I said before, is an infrequent event, but something that if it did happen would have potentially catastrophic effects to your agency. So you take an example of if there was hurricane damage, that could be $10 million, it could be a $50 million claim depending on your values. But ultimately, that's something that you can't easily fund for. You can't easily predict whether it will happen or not. So the second part of property insurance and why we recommend it for those bigger types of events is that it aids in stability for your budget. With the state of Texas having to go to the legislature with a 2-year report that basically, my understanding, kind of estimates what your costs will be, it'd be very difficult to have a $10 million loss that happens during that 2-year cycle because there's no direct fund immediately available to pay for that. Oh, here's the clicker. Sorry, it was the clicker. There we go. An overview of what the state of Texas property program looks like. Michelle mentioned this in the beginning, but the design of all of the SORM insurance programs, which there's auto liability, directors and officers of property insurance, and a couple of others, but they're all designed to take the massive scale of the state of Texas and its agencies and bring that to bear in the insurance markets. What it ends up, what it leads to is lower costs to each of your agencies, and then also it provides economies of scale in terms of just coverages that normally you couldn't receive in the insurance market if you went out alone and tried to negotiate it on your own account. Last thing is stability. Is with having, Michelle mentioned the patchwork quilt, we have 26 carriers that participate in the current insurance program. By having there's about $9 billion of total assets that are in this program. by having that leverage in the insurance market, it assures that if there is an insurance company that goes out of business or other situations happen, that we have enough interest in the general global insurance market that we can easily replace it if it ever came to be. So that provides stability, which I think is critical with the state agency where you have to budget out so far in advance for costs. And then the last thing I'll mention specifically on coverage terms is that the policy form was designed for SORM and for the agencies. So we have unique risks like higher education. We have other things such as historical buildings. There's actually wording in the policy that specifically addresses those issues. And last thing, which we'll talk about later today after lunch, is business continuity. So business continuity actually flows directly into the insurance coverages that are provided, and we'll talk about some claim examples this afternoon on that. A few risks, Hobie mentioned some of these actually in this presentation as well, but things that these insured perils. So in order for a property claim, property insurance to kick in, it has to be one of a variety of types of events. So these are the most common. These are actually where we see a lot of these SORM claims come from. But fire is a pretty common example. It could be, I left a cigarette in the trash can in the bathroom and lit the building on fire. It could be a wildfire, like Hobie had mentioned on the National Event. We did some of those a couple years ago that happened to damage some homes. Frozen pipes is one that we've been getting a lot recently, just with the hard freezes that come through. You have a pipe freezes, it bursts, and causes resulting water damage. Hail, flood, I think are pretty common. Interesting thing about flood is that, according to FEMA, the most likely, or the number of claims they receive are actually higher in what they would consider low hazard flood areas. So just because you're not in a high hazard zone doesn't mean you can't have flood damage. Windstorms, pretty obvious. Hurricane, events such as 9/11, terrorist type events, arson, the governor's mansion, those types of incidents are the hazards that we protect against.
I have a question, just out of curiosity. Has terrorist events kind of replaced the caveat of acts of war, or is there too well defined?
They're very well defined. So war is something that is, like, let's say the U.S. declared war on another country that somehow caused damage to one of your facilities. That is a sort of exclusive, always excluded coverage under property insurance.
Okay.
Now, terrorist events are a little bit different in the sense that it's not a purposeful military attack or on a foreign government, let's say. So if it was 9/11, if you had even domestic terrorism, we have seen events that are similar to that, but those types of events aren't covered. And we actually have a specialized policy through SORM that protects against those types of events. There used to actually be a federal distinction on domestic versus foreign, whether it's a foreign person or a domestic, like an Oklahoma City bombing type of incident. There's no longer a delineation. So overall, in terms of risk, we mentioned a few things that are covered under the program. In order to actually determine from a natural peril standpoint what your agency may be exposed to, we have a partnership with Swiss Re, and one gentleman spoke earlier from Swiss Re, and that they provide us a software program that assists in developing some risk assessment for your agency. And SORM and the risk managers can walk through this specific to your exposures. But what it does is you take, essentially it's Google Maps or Google Images, and basically you take your exposure data, so what you own, where it's located. We can plot that onto a map of the state of Texas and overlay exposure, so we can see, is your building in a flood zone? Is your building exposed to tornado? Believe it or not, there's zones in Texas that are more exposed to hail and tornado than others. So we can overlay that, and SORM can work with you on determining that.
Can I add something to that? As part of your COOP plan, this is a service that, having this property program, we're going to open up to all state agencies. The reason we're going to be collecting data on your assets and both your contents and your buildings
is in order to dump it into the CatNet program, then be able to educate you on the exposures that your assets have from catastrophic exposures. You know the floods and the fires and like a broken pipe flooding in your building, but are you aware of hurricanes, river floods, tornadoes, hail, and the exposure that you have? Once we provide that information to you, we'll be looking to see that you're addressing that within your COOP plan, because it is an actual exposure that your agency has.
Very good. Last point on this is you can also, by having your assets mapped on the state of Texas, we can determine what type of concentration of values you have. And the reason that's important is if you had, let's say you had 10 buildings, they're all $10 billion each. Well, loss to that building, depending on the size of your agency, may not be catastrophic. However, if there was a wide-scale event, such as a hurricane, tornado, and it impacted all 10, well, that's $100 billion of exposure. So we can also provide that data to you as well.
Okay, well, I'll turn it over to Michelle to talk through how obtaining more information.
But I think just the last point on the business continuity, I think it's easier to think through property insurance when you see the types of claims that can be covered and the coverage elements that would fall in. So we'll talk about that this afternoon as it relates to business continuity.
Oh, sure. I mean, anyway.
Thank you.
Don't go away angry, just go away.
Use our property SORM website. And what I'm showing you here is how you can learn more information about the property program that we currently have if you are interested in obtaining a quote for your property. I used to be a risk manager who traveled around to different agencies in the state, and one of the recommendations that I would make to my agencies that I was working with was, if you are a risk manager and you are aware of an exposure that you potentially have with your agency, obtain an insurance quote and present it to your upper management. Then you, as the risk manager for that agency, have done your due diligence of educating your upper management on potential exposures. It is not compulsory, and you are not forced to purchase the insurance, but you've taken the time to look at that exposure and to present it to your upper management to make a decision. So if you, as an agency risk manager, would like to do that, this is where you can find the information. I did put a handout out the front there for you if you'd like to take it. It gives you step-by-step instructions, and it gives you a copy of this form. But this is where it is on the website. So we go to the www.sorm.state.tx.us, and you'll see in the middle I've got an insurance services there. It'll drop down, and you can see the statewide property insurance program. We'll open up this screen and give you some information, which is the same as this handout here. And it has some attachments down the bottom, forms. You'll click, there's 3 of those forms. The last one got cut off, but on the website you'll see 3. One is for contents only, if you do not own the building. There is a building insurance form, and on those tabs of that insurance spreadsheet has all the information, the types of occupancies, the ISO codes that you heard Steve talk about earlier, and it goes through and explains what those are to assist you. You'll fill out these 3 forms, and then you'll send them to the bonds of insurance, which is a hyperlink there. Once you've completed the forms, you can send it through as an email, and we can get a quote for you. Otherwise, my business cards are also out there, and you're welcome to email it directly through to me. I am available at all times for questions. I do get a lot of questions from agencies that are filling this out, so I am available at all times. There's my contact information if you would like to ask any questions. Even if you're not sure, feel free to give me a call. I'm here. As a little caveat, SORM doesn't receive any commission. I don't get anything for this other than making sure that you've been educated about the exposures that you have and that you're making educated decisions. Thank you very much. I do have a special mention. Today is Chris's birthday. Had I known it was his birthday, I might not have planned the event on his birthday. We wanted to celebrate with you. So,